Hello and welcome to Business Arena on TVP World. I'm your host, Marie Cato. Join me for the latest business headlines of the day. Hungary is set to lose over 1 billion euros in EU cohesion funds, the first case of its kind in the bloc's history. The unprecedented move follows the Hungarian government's failure to meet anti-corruption and transparency requirements set by the European Council. The decision stems from a conditionality mechanism introduced in 2020 to protect EU finances. Officials are warning that Budapest could lose further tranches, starting with an additional 1.1 billion euros by the end of 2025, if it continues to ignore calls for reforms. Hungary is already barred from accessing 10 billion euros under the EU recovery plan due to similar concerns. Following the release of Poland's funds earlier this year, Hungary remains the only EU country with both cohesion and recovery funds frozen. The shortage of EU funds is already affecting the Hungarian economy, which is in a technical recession and suffered a massive drop in investments recently. Economists also point out that the lack of funds will substantially impart growth in 2025. The matter naturally became political, with opposition figures campaigning on the return of EU funds. While it was a rocky year for most markets across the globe, here in Poland, it's been steady as can be. While there were a couple of significant shifts during the summer, the Polish market has ended the year in the money, albeit without any fireworks.
If we look only at Poland's top blue chip stocks in the VIG20 index, we could be inclined to say it's been a bad year for investors. But that's not entirely the case. Looking at this year's trajectory, we see that the year is ending on a much less enthusiastic note than was seen in spring. In May, the index approached performance not seen since 2018. Now it looks like we'll end the year in the red. Much of this, however, was a result of the incredibly poor post-election performance of Polish state-owned enterprises, such as oil giant Orlen, energy firm PGE, and coal producer JSW. Polish banks, on the other hand, did extremely well, as did this year's star performer, game developer CD Projekt, which has seen its stock rise a whopping 69% since the start of the year.
Look, whoever bought equity, diversified equity, including smaller caps and medium caps in Poland, is in the money. Even if it is less than risk-free rate, it is not a down year in the equity market.
It must also be underlined that the VIG20 results do not include the good dividends being paid. And if we take the mid and small caps into account, we're looking at a gain of almost 2% this year. Now, on the fixed income end, there are some surprises. Polish 10-year bond yields went up against all expectations. They're nearly at 6% at the moment. External factors are the key culprits here.
It is the US yields that have surprised everyone, going significantly up this year. And the move in Poland is corresponding with the move in the States.
Polish bonds do remain very stable, taken against the kind of swings being seen in the US. Another positive signal coming out of the Polish market this year is the relative stability of the Polish zloty. It's fallen over 4% against the dollar so far this year. But compared to the euro-dollar's 8% move, the zloty's is showing resilience. Over the past year, the Polish zloty, although experiencing some volatility, has been marching steadily ahead against the euro, up almost 2% year to date.
Zloty reflects a very stable position of Polish economy and Polish geopolitics versus the rest of the European Union.
In total, the news coming out of Poland fails to excite. That might be bad news for speculators. For others, however, it could be just what the doctor ordered.
For those of us that aren't experts in the field, the world of stock markets may seem a bit abstract, but a lot of what happens out there can tell us about the strength and wealth of a country's economy. On the bottom line today, we'll take a look at what kind of year it was for Warsaw Stock Exchange and whether it's early enough to know what next year might hold. More than half of Poland's GDP has been generated by only 5 out of 17 regions, according to Statistics Poland. This means that Warsaw, the capital of the country, contributed 9 times as much as the smallest region of Opole. Taken together, Warsaw and its immediate surroundings are responsible for 18.3% of Polish GDP, the biggest contribution of any region. By comparison, the next region in line generated only 1/10 of the GDP, and the next 15 regions' contribution is in single digits. The disparity between the capital and the rest of the country can also be seen in other statistics, like the contribution of GDP per inhabitant, which in Warsaw is 2 times the average of the whole country. Consecutive Polish governments have tried to spread economic growth across the country to limit the concentration of wealth in only big cities. Compared to the rest of Europe, this has been successful. The French Parisian region contributed 30% of GDP, and in the UK, London generates 25% of British GDP. The Polish government is ready to step in should Slovakia cut the supply of electricity to Ukraine, a Bloomberg report has said. The declaration, based on an anonymous source within the government, leaves an open question. Is such a feat even possible?
A destroyed power plant? It is an everyday reality for Ukraine. This winter, the country is counting on help from its neighbors for power supply, but it may turn out that some will not provide it. Slovakia's Prime Minister Robert Fico has warned he could suspend electricity exports to Ukraine on the back of Kyiv's adamant stance to end the transit of Russian gas via its territory on January 1st, with Bratislava one of the major recipients of the resource.
Slovakia could theoretically halt energy, but by doing so it would undermine the functioning of the European Union's common energy market. Ukraine is part of this common market, meaning there's no possibility of unjustified blockage of energy transfers. Robert Fico's move would trigger repercussions throughout the entire Union.
Ukraine's power grid is linked through several interconnectors with neighboring countries, including Poland and Romania, both of which play a more significant role than Slovakia in keeping the lights on. Since March 2022, Ukraine and Moldova have been synchronized with the European grid, fully detaching from the post-Soviet system. This makes cross-border power trade more feasible, even if there are hurdles in ramping up the grid's capacity. Currently, power to Ukraine can be sent only via the Rzeszów-Chmielnicki line.
The link between Ukraine and Slovakia has a capacity of around 260 megawatts, while the link between Poland and Ukraine has twice that, 550 megawatts, meaning that theoretically the flow of energy from Slovakia could be replaced by that from Poland.
The issue lies in the actual capabilities of these transmission lines.
The grids of Poland and Ukraine were synchronized in May 2023. Both now operate using the same parameters, but it's like water. Imagine pouring water through a large pipe into Ukraine, only to run into narrow pipes with limited capacity further down, causing the flow to stop. The same applies to electricity.
Polish grid operator PSE said in July that in theory the line could carry up to 1,000 megawatts, but increasing that limit would require approval from other grid companies forming the Pan-European Alliance. Taken together, all European links to Ukraine can carry up to 1,700 megawatts of power.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.